Welcome to episode 10 of the SaaS Report. I'm your host, Matt Aird, founder and CEO at Sales Science. And today we're going to be looking at Q3 results from Procore and Confluent. We're going to be checking out the change in R&D and sales and marketing spend by some of the more successful SaaS companies. So how that spend ratio changes over time. We're going to take a look at how Rippling has been growing ARR so quickly. So Rippling's a private SaaS company. There was an interview from their CRO at SaaSta recently. So we're going to be breaking down some of the insights that he shared around how they structured their sales and go-to-market teams. But first, let's get to the news. So just this morning, about 20 minutes before recording this, Procore released Q3 results, and they weren't great. So they grew ARR 19% year over year, but that growth is down from 33% in Q3 of 23. So a bit of a drop off there. They did manage to reduce operating loss by almost 40%. So they cut that from 50 million in Q3 of last year to 36 million in Q3 this year. But at the same time, go-to-market efficiency has slowed down. So they only added 908 net new customers in Q3 this year. That was compared to more than 2,000 customers that they added in Q3 of 23. Magic number is down as well. So that's reduced from 0.61 down to 0.36. And then CAC payback has increased from 23 months to 41 months. Free cash flow margin, that dropped slightly as well. So that's down to 7.7% from 9% a year ago. So looks like much tougher going for Procore at the moment. The share price looks to be trading down. It's down about 3.5% in trading after hours, but they're still trading at about 7.8 times ARR, which puts them on par with where they were at after releasing Q2 earnings last quarter. We also got Q3 numbers from Confluent. So Confluent had a really good Q3, generated 27% ARR growth, reduced operating loss by 31%, and improved go-to-market efficiency by 14%. So they saw magic number improve from 0.4 to 0.45. CAC payback reduced from 39 months down to 33 months. They added 240 customers in the quarter. So that was a big improvement for them. They added just 80 net new customers in Q3 of last year. So when you break down total sales and marketing spend by the number of customers added in the quarter, we get some interesting numbers. So they spent $553,000 per customer, per net new customer that they acquired in Q3 of this year. That was compared to more than 1.5 million per net new customer in Q3 of last year. So much better go-to-market sales efficiency from a kind of a raw customer count number. Couple of downsides though. So NRR dropped. So they were at 130% net revenue retention in Q3 of last year. That's down to 117, and slower ARR growth. So still at 27%, but that's down from 37% in Q3 of last year. They're trading at 7.8 times ARR right now. Okay, first thing I want to cover today is this tendency that I've seen in some of the best SaaS companies, the companies that have reached true scale and have been able to maintain high rates of ARR growth. And that is this tendency to reduce the amount of revenue that's spent on sales and marketing and increase the amount of revenue that's spent on R&D over time. And there are three pretty clear examples of this that I found looking back through the metrics that we've tracked, right? So the first example I want to take you through is HubSpot. Right? HubSpot is a company that has grown at a remarkably consistent rate since going public. And what we can see when we look at their allocation to R&D spending and sales and marketing spending is that those two lines are converging over time, right? So if we look at this chart here, what we can see is that in 2016, HubSpot spent about 60% of revenue on sales and marketing and just 17% of revenue on research and development, right? Which means that they're much more focused in 2016 on attracting customers through sales and marketing efforts than they are on kind of building out the product suite. But over the last 8 years, right, the spend in these two categories has converged. So in Q2 of this year, HubSpot reported that they'd spent 30% of revenue on R&D and 47% on sales and marketing. So sales and marketing spending is reducing by about 3% per year, and spending on R&D as a percentage of revenue is increasing about 7.5% per year. And if we look at ServiceNow, we can see a fairly similar trend. So in 2011, ServiceNow spent 9% of revenue on R&D and 41% of revenue on sales and marketing. If you fast forward to today, they're at 24% on R&D and 37% on sales and marketing. And if we look at Datadog, right, they're even more extreme. So they went from a spend of 44% on sales and marketing and 25% on R&D to 29% on sales and marketing and 45% on R&D. Right, so what we can see in these three examples here is that as the revenue run rates for these companies increase, and as they kind of sell to more of their addressable market, they're allocating more and more of their resources to improving the products, right? And whether that's improving the kind of existing product suite, whether that's making sure that they're a multi-product company, whether that's improving some of the interoperability, the usability, right? The breadth of features that they offer customers, right? A lot of investment is going into this. And the reason for that is because the customers that are easiest to convert, right, or i.e. the ones that are easiest to sell to, have already bought your stuff. And so if you want to continue to sell to more of the market, you need to find new ways to attract the next incremental customer. Now, when you're early in the journey, you can do that through go-to-market means, right? It just means, potentially being at more events or hiring more salespeople or spending more money on, branding and marketing so that more of your potential customers are aware of you. But once you've kind of like saturated that spend level and everyone in the categories that you sell to knows you exist, you actually need to move that spend into product improvements so that they're more attracted to coming on board, right? There isn't additional sales and marketing initiatives that you can deploy in order to bring them on. You need to actually improve the product so that they're incentivized to become customers. Now, you might think that switch, right, comes at a trade-off, right? If we're going to be spending less on sales and marketing, or we're going to invest less in that part of the business, that we might see a drop-off in terms of go-to-market efficiency, right? If we're changing more of our focus onto the product, does go-to-market efficiency suffer? And the answer to that appears to be no. And the way that we can look at that is by the fact that these companies are outgrowing counterparts that spend less on R&D, right? So HubSpot in Q2 of this year grew at 21%, Datadog grew at 27%, ServiceNow grew at 23%. These three companies spend at least 24% of revenue on research and development. If we compare that to some of the slowest growing SaaS companies on our list from Q2, right, ZoomInfo, they only spent 17% of revenue on R&D. They had negative 6% ARR growth year over year. Zoom, they spend 18% of revenue on R&D. They only grew 5%. WalkMe, they spend 17% of revenue on R&D. They're only growing 7%. DocuSign, they're spending 20% of revenue on R&D. They're only growing at 7%. So the key learning here is, yes, we're all chasing ARR growth, right? We want the top line to grow, but we need to remember that often we can generate that growth by actually just improving the product, right? If we build a better product, if we build a product that's richer in features, if we build a product that solves our customers' problems better, then typically it's going to make it easier for us to attract customers. And it's not just about, allocating more investment to sales and marketing. The second thing I want to cover today is the story behind Rippling's go-to-market motion. So Rippling is one of the fastest growing private SaaS companies in the world today. And their CRO, Matt Plank, was interviewed at SaaStr this year. And in that interview, he uncovered a couple of key things that have enabled them to grow so quickly, and also revealed some information which helps us to back into some of the numbers that they might be doing, specifically in terms of how their outbound team is structured and the results that they're getting. So the way that Rippling started in their go-to-market motion was to run a very kind of like programmatic outbound motion. And so you could just think of that as like, getting a database, so buying a subscription to ZoomInfo and just sending, thousands of automated emails out to the market every month. And then they almost termed it like inbound SDRs, just respond and reply to people responding to those emails, right? So there was no personalization, there's no cold calling, there's no LinkedIn outreach. All it is just templated emails being sent to ICP customers to see who was going to bite. What Matt revealed here is that the response rates that they were getting to that was about 0.5 to 1% conversion ratio from an account worked into a meeting booked. So for every 1,000 organizations that they were reaching out to, they were booking somewhere between 5 and 10 demos, right? And that enabled them to scale to a certain extent, but they got to the point where in order to hit their growth goals, the TAM wasn't large enough for them to just continue to operate in that way, right? They needed to figure out how to actually improve the conversion rate from account worked into meeting booked, because the TAM wasn't large enough just to continue converting at 0.5 to 1% in order to hit revenue growth goals. So what they did was they started to build the outbound function, and a lot of that was centered around cold calling. What they found was that by introducing cold calling, where they're booking about 50% of their meetings, they were able to increase the conversion rate from account worked into meeting booked to between 3 and 7%, depending on the segment that they were working, right? So now when they're reaching out to 1,000 accounts, instead of booking 5 to 10 meetings, they're generating somewhere between 30 and 70, depending on the segment. Now, since implementing that process, they've scaled this outbound team really aggressively. So they've now got 150 SDRs that are executing this outbound motion, right? 50% of the meetings that they book are through cold calls. The other 50% are from LinkedIn and email outreach. And Matt mentioned in the interview that they're booking about 1,300 meetings a month through that outbound team, right? So if we take those 150 reps and we take the conversion rate that they've given us, we can back into a number of about 8.75 demos booked per rep per month through their process at the moment, right? So that helps to kind of like set expectations there around like what's possible from an outbound motion, right? If you've got a really scaled outbound team, talking hundreds of reps, they're working on average, again, backing into these numbers, about 175 accounts per rep per month, and they're generating about 8.75 demos per rep per month. Now, when they look to try to improve efficiency through this organization, one of the ways that they're deploying AI is by using AI to help them identify the accounts that they should spend their time targeting, right? So they do kind of like base level ICP analysis initially, which is things like, okay, what industry are they in? What's the employee head count, right? Where are these organizations based? They've got their high level kind of ICP descriptions there. And then what they do is they use AI to then help uncover some of the kind of like harder to identify things, right? Which is like, how many social followers does the company have? Is there any kind of like news or announcements that mean they might be more likely to buy? How old is the company, right? Is there someone that's in the organization now that's just moved in, right? And we can use that as a way to start a conversation, right? So they're using AI to provide kind of like additional layers of, think of it like account scoring or lead scoring, to help the reps identify who they should be reaching out to and when. One of the other things that Matt mentioned that they've done well is that they're rolling out this model that they call a compound startup. So this is a term that was invented by their CEO, Parker Conrad, and essentially a compound startup, you could think of that as like a company that becomes a multi-product company very quickly. So Jason Lemkin at SaaS that talks about this a lot, which is that SaaS companies need to move to becoming multi-product companies sooner than they want to or sooner than they think they need to. Right, so if you think about HubSpot as an example, HubSpot started out as a marketing automation software, but they now offer Marketing Hub, Sales Hub, which is effectively CRM, and then a Service Hub for customer success as well. So HubSpot is now a multi-product company as opposed to just being a marketing automation company. And so Rippling has done this very early in the journey, and they now have kind of 4 key kind of like segments within their business, and that is human resource management, payroll, IT, and then finance or spend management. And one of the challenges that they ran into as they were scaling their go-to-market function was that as they continued to add products, and they call them SKUs, right, to the business, it became hard for the salespeople to stay on top of the new product innovations, right? It's like, okay, we're introducing 5 or 6 new products a year. They wanted the salespeople to be able to sell all of the products. But they quickly ran into issues there where salespeople were just kind of like overwhelmed with the information that they had to consume and then convey to customers. They also found that because their reps were spread pretty thin across these product sets, they were losing a lot in competitive deals, right? So if a salesperson that was selling across all 4 of those suites, right? So think, HR, payroll, IT, and then spend management. If that person has to keep, the information and the kind of the competitive positioning across all of that market space, right, then when they run into a competitive deal with a rep that's just focused in one of those areas, they were finding that they were losing those deals, right? Because the rep that was focused on spend management, for example, could just talk at a lot deeper level and in more detail to the customer's problems than the rep who was spread across a bunch of things could. And so the structural changes that they made to the business was to basically create mini business units from a go-to-market motion, and then create management layers and infrastructure around those business units. So now they've got really defined go-to-market teams across those 4 segments, and that's enabled them to kind of like win more of these deals, right? Because the salespeople don't have to be as spread as thin across multiple products. They can go deeper into their domain expertise and understanding the problems and the solutions that exist for customers in that space. Now, one of the things to think about that Matt raised here is if you're looking to do this, you need to make sure that the business unit, you could think about it that way, is going to be large enough to be self-sustaining, right? So let's take HubSpot as the example, right? They had their marketing hub first, they then introduced the sales hub. So when HubSpot is deciding how to structure their go-to-market team, if they wanted to set up a specific go-to-market motion for the sales hub, they would have to make sure that that could be kind of a self-sustaining business, right? And the way to think about that is like, are there enough potential customers for us to sell to? So like, is the TAM big enough? And are we going to be able to sell this at a high enough price point to justify the sales motion that we're putting in place? If you can tick those 2 boxes, then you can set up a separate go-to-market function for that team, and it should be self-sustaining. The third thing that Matt talked about was how they structured their kind of customer success or account management teams, right? So the way that they started initially was to have just customer success managers. And they thought of customer success managers as basically just like, churn prevention, right? So it's like, think of them as like high level kind of one-to-one customer support. And so what happened in this situation was like, if an opportunity arose for a cross-sell opportunity into an account, what the customer success manager did was fold in one of the new logo account executives. Right, so let's say that that company is currently buying the human resources management suite, and then they want to add payroll. That customer success manager would bring in the new logo account executive to try to close that deal. The problem that they ran into with that structure is that the new logo account executive wasn't incentivized properly to spend time on that deal. Right, they're chasing new logo acquisition where they're potentially looking to sell multiple products. And so the potential deal size there is larger than selling one product, right, in the early days. And so what they needed to do was to figure out instead, okay, how can we get our retention team to manage this kind of like cross-sell or upsell function? Now, the reason that they felt comfortable making the switch was that they felt that if someone was going to churn, then there probably isn't a lot that they're going to be able to do about it. Right, so let's just put in account managers and have them incentivized to kind of try and cross and upsell. Yes, we'll manage and coach them. We'll develop playbooks around how to manage churn, but it'll just be kind of like a byproduct of them doing their job well. What they found here was that when they dug into accounts that had churned, they found that the account managers who were incentivized to kind of like cross-sell, but not incentivized to retain customers, didn't do that job very well, right? It's like there wasn't a ton of effort put into actually retaining customers who are at churn risk. And the reason for that is because there was no incentive for them to do so, right? They were compensated on cross-selling customers into new product suites. And so what they did is, in a way to redesign this, was that they gave the account management function a retention quota. So part of their compensation was tied to retention. And then they restructured the way that that account management team worked with account executive or closing teams in order to cross and upsell. Right, now, this ties back to this age-old kind of like Charlie Munger quote, which is like, show me the incentive and I'll show you the outcome. You need to make sure that when you're designing kind of roles and responsibilities across your go-to-market team, that you're incentivizing for the behaviors that you want to see in your people. And if you're only doing that through like a stick as opposed to a carrot, you might not get the results that you're after. All right, so yeah, really fascinating interview. If you like that overview that I've given you there, go and check it out. It's on the SaaS to YouTube page, CRO Matt Plank. being interviewed at SaaS did just a couple of months ago now. And finally, I just want to cover Reddit's quarterly earnings announcement. So Reddit announced earnings late last week and the share price popped 40%. So the social media company delivered an unexpected profit for the quarter. So net income came in at $29.9 million, up from a net loss of $7.4 million in the same quarter last year. They also reported a significant increase in daily active users. So that's up to almost 100 million now. An increase of 47% year over year. And consequently, revenue was up. So revenue was up about 68% year over year to $348.8 million for Q3. Wall Street had them pegged at about $315 million in revenue for the quarter. So a pretty handy revenue beat there. Prior to going public, there was a lot of talk about Reddit selling access to its data to the LLM developers, right? So it had reportedly struck deals with OpenAI and Google to sell access to its content for those companies to train their models on. But in Q3 announcement, the CEO said that they're going to be kind of more strategic about how they provide access to this data in the future. He said, so we're open for business and finding the right balance between making this information accessible and building our own products on top of it. Now, these deals were fairly small in the grand scheme of things, right? I think they had licensing deals to the tune of about $200 million with companies like Google in the mix there, but that likely long-term won't have a significant impact on revenue. If they can continue to compound revenue from the core ad business, right, that's up to 348, so they're at about a $1.4 billion run rate right now. If they can continue to compound that over time, right, then they're going to be in a good spot. That's all for this week. Thank you so much for watching. As always, if you have any feedback, please let me know. Any questions, any comments, any advice on how we can make this better, reach out to me. I'll see you next week. Until then, goodbye.